Money has a strange way of creating confidence right before it disappears. Every major financial collapse in history shares the same quiet beginning. Not panic, not fear, but certainty. A widespread belief that this time is different, that the system is smarter now, that the risks are understood, measured, controlled. And for a while, that belief looks correct. Markets rise, credit flows easily, fortunes are built faster than ever before. People stop asking where the money is coming from. They start asking how to get more of it. Debt no longer feels dangerous. Leverage feels like intelligence. Risk feels like opportunity. This is the moment when the financial system is most fragile, because the greatest threats to money are rarely obvious. They don't arrive loudly. They hide inside things that feel normal, familiar, necessary, even boring. And one of the most dangerous of those hidden threats is something almost no one pays attention to until it's too late.
Liquidity. Liquidity is not wealth, it is not value, it is not even money in the traditional sense. Liquidity is belief. The belief that when you need to sell, someone will be there to buy. That when you want cash, it will appear. That markets will function tomorrow the way they function today. Modern finance is built on this belief. Stocks trade because buyers exist. Bonds hold value because someone is willing to hold them next. Banks operate because depositors trust they can withdraw funds on demand. Entire economies rely on the assumption that liquidity will always be there when required. But liquidity is not guaranteed. It is borrowed confidence. And when that confidence cracks, the system doesn't bend. It snaps. To understand why liquidity is so dangerous, you have to understand how little of the financial system is actually backed by real, available money. Most people imagine banks as vaults filled with cash. But banks don't hold your money. They lend it, they invest it, they multiply it. For every dollar deposited, several more dollars are created through loans and leverage. This works beautifully when trust is high, but trust is the only thing holding it together. If too many people ask for their money at the same time, the system cannot comply. Not because the money was stolen, but because it never existed in liquid form to begin with. This isn't a flaw, it's a design choice. Modern finance prioritizes efficiency over safety. Capital must always be working. Idle money is considered wasteful. Liquidity, therefore, is stretched thin across layers of promises, contracts, and expectations. Most of the time, no one notices until something breaks. In 2008, the world learned this lesson the hard way. Mortgage-backed securities were treated as liquid, safe, tradable assets. Banks held them. Funds relied on them. Balance sheets were filled with them. But when housing prices stalled, liquidity vanished overnight. Suddenly, no one wanted to buy. Prices collapsed not because the houses disappeared, but because belief did. Assets that looked solid became untouchable. Markets froze. Institutions that appeared healthy failed within days. The real crisis wasn't housing, it was liquidity. Central banks stepped in, injecting trillions to restart belief. Interest rates were cut. Emergency lending programs were created. The system survived, but at a cost. A dangerous precedent was set. Markets learned that when liquidity disappears, central banks will restore it. And that lesson changed behavior permanently. Risk-taking increased. Leverage expanded.
Financial instruments became more complex. Investors chased yield in a low-rate world. Liquidity was assumed to be infinite. But infinite liquidity is an illusion. Today's financial system is more interconnected than ever. Assets are linked across borders, currencies, and institutions. A shock in one market can ripple instantly across the globe. And because liquidity is shared, stress spreads faster than value can adjust. What looks like diversification often turns out to be concentration. Everyone is exposed to the same belief. The danger isn't a single collapse, it's a chain reaction. When liquidity tightens in one corner of the system, institutions are forced to sell assets to raise cash. Those sales push prices down. Falling prices trigger margin calls. Margin calls force more selling. Liquidity dries up further. This is how markets fall faster than logic suggests they should. Not because assets are worthless, but because there are no buyers at the moment sellers need them most. And this vulnerability exists everywhere, in government bond markets assumed to be risk-free, in corporate debt built on rolling short-term funding, in shadow banking systems that operate outside traditional regulations, in derivatives markets so large that no single entity understands the full exposure. Liquidity is the invisible thread tying it all together. When that thread holds, the system looks strong. When it snaps, everything unravels at once. The most unsettling part is how quickly confidence can turn. Liquidity doesn't decline gradually. It disappears suddenly. One day, markets function normally. The next day, bid-ask spreads widen. Trades fail to clear. Prices gap violently. Institutions stop lending to each other. Fear replaces trust. At that point, no amount of models or forecasts matter. Only cash matters. And cash is always scarce when everyone wants it. This is why the most dangerous moments in finance are not crashes themselves, but the moments just before them, when liquidity is silently thinning, even as prices rise. High valuations mask fragility. Calm markets hide stress. Stability creates complacency. And complacency creates leverage. The system becomes efficient, optimized, fragile, just waiting for a trigger. The trigger could be anything: a policy mistake, a geopolitical shock, a sudden rate hike, a large institution failing quietly behind the scenes. The cause is rarely as important as the structure. When liquidity is stretched too far, the system doesn't need a big shock to break. It only needs a small one in the wrong place. This is the paradox of modern finance. The tools designed to make markets safer, leverage, derivatives, liquidity provision, often make them more dangerous by encouraging risk to accumulate invisibly. By the time the danger is obvious, it's already too late. Liquidity has already left the room. And when it does, the question is never who caused the crisis. The question is who survives it. Because in a liquidity crunch, strength is not about intelligence or strategy. It's about access. Access to cash, access to funding, access to confidence. Those without it are forced to sell at the worst possible moment. Those with it buy what others are desperate to escape. This is how fortunes change hands in silence. And this is why Liquidity, more than debt, more than inflation, more than speculation, remains the most dangerous hidden risk in finance, not because it is rare, but because everyone assumes it will always be there, until it isn't. Welcome to Cash and Chronicles, where money, power, and history collide.